Hello and welcome back to Property Matters on Dublin South FM and on iPropertyRadio with myself, Carol Tallon. You can contact us on social media at iPropertyRadio or email hello@iPropertyRadio.com. This week, joining me is Neil Bannon, Executive Chairman of Bannon. Neil, you're very welcome. Thank you for joining us.
Thank you, Carol. Thanks for having me on.
So, Neil, I had the great pleasure of sharing a stage with you last week at the National Property Summit, and I think it's fair to say that the mood across the industry has changed. The uncertainty maybe is becoming a little less uncertain and not in the direction that we would have liked it. So you might just talk to us. Well, maybe first of all, share with the audience the type of work that you and the team at Bannon are involved in.
Okay, well, Bannon are a commercial property consultancy, so we advise all aspects of commercial real estate with a heavy focus on retail. About 75% of our business in the retail sector, about 25%, mainly offices, a small amount of land as well. So it's been an interesting sector to be in over the last 20 years because it's been ups and downs. We manage an awful lot of Ireland's retail stock. About a quarter of Ireland's shopping centres and retail parks are under our management on a day-to-day basis, which gives us a great insight into just the health and vitality of the sector and what's going on. We have an active involvement in city centre offices in Dublin, usually on the development side. More recently, in terms of looking at the greening of that sector and how the environmental wave that's coming across the sector is going to be played out.
I think it's interesting when you talk about the environmental wave. I just saw this morning in the Irish Times, there's a report on the future of commercial real estate. And one of the kind of general statements there was that non-ESG compliant buildings are really going to struggle a lot sooner than we might have expected that to happen. So what are you seeing across, I appreciate that you're primarily in the retail, but across retail and the office space?
The office space is leading this charge more than retail currently, and we analyse. We're data junkies in Bannon, so we database the entire Dublin office market and the entire Irish retail market. And the Dublin office market is interesting that in the CPD we've got in our database 460 buildings, and 400 of those were built in the last century. And of the 60 that were built in this century, most of them were built in the early 2000s. Because we had a real flat spot in the tower from 2009 to 2014. So anything built before 2014 doesn't comply fully with current green regulations. So the vast majority of existing stock is not green enough for the corporate market, as reflected in that study you referenced in the Irish Times. I think we're going to see a massive shift. We call it the sort of musical chairs in the office market, that everyone's looking for the green chair to sit on before the music stops. And there is that shift is going to be accelerated now because the vacancy left by some of the pullback in the tech sector is going to create more opportunities for people to shift into green buildings than would have been the case heretofore. We have about 40 million square feet in Dublin office market, 25 million in the city centre, which is where the main corporates are located. And so you've got a lot of million square feet to be moved into green buildings in a relatively short period of time. And we think that the reshuffle is going to manifest itself in some very well located buildings which are no longer suitable for office usage, unless they get substantially upgraded from a green point of view or repurposed. And you're going to see a lot of professional services firms moving into some of those buildings left vacant by the tech step back. So there's in terms of valuation, probably a little bit of head in the sand in terms of what this means for valuation in some of those older buildings, to be honest with you. I think that the delta between a new, shiny, green, appropriate building, a 60 euros square foot, 4%, and a similarly located but non-green building have not been fully reflected in valuations or the market at the moment. And I think that's going to be one of the big stories for next year, will be how that plays out in terms of valuation.
Yeah, the head in the sand approach is interesting. Just before we started recording, I think you and I were just having a brief conversation there, and that's one of the things that we're seeing shift in the industry. There was almost a collective unwillingness to look at what the data was telling us for the direction that the market is going in, and there was that little bit of a head in the sand. And it's illogical to see now, but through PropTech Ireland, we're still meeting not just real estate operators, but we're still meeting developers who don't fully appreciate ESG, who think that this is a tick box exercise, who think that this is, gosh, I've even spoken to people who believe that this is a current trend, and actually when the market gets difficult, that this won't be a priority. And it's difficult to imagine how that mindset still exists at a high level across the industry today, because I mean, you painted what I think is an interesting picture of offices, because the reality is, I like when you call it a reshuffle, but we know that real estate is changing, and that's not just because of sustainability concerns, and it's not just because of COVID. This was happening in advance. You're somebody who follows the data, so it must be frustrating for you, like going back pre-COVID, to hear a lot of anecdotal commentary about retail, and yet maybe the data wasn't used to back that up. So take us back to pre-pandemic. How were we getting our commentary of retail wrong?
I think that there's been so if we track back to say 2007, because it's where the sort of the wave crash recovery sort of goes, so retail was flying in 2007. We opened, I think, 7 shopping centres in 2007. There were 11 open in the Irish market. Everyone was happy. Everyone was dancing into the schemes because the Irish consumer was their own on a wave of debt, enjoying themselves in terms of spend. That crashed in 2008, and we had what we described as a retail recession from 2009 to 2013. Even though the country had recovered from, we can actually track it through our data to November 2013, I can be that precise, because from November 2013 onwards, for 7 years, we had month-on-month, year-on-year growth in retail. So we had a 7-year retail boom, because that's when you get 7 years of growth. That's what we normally call those things. But I can't pick up at any point during that 7 years a particularly positive commentary on the sector. We had vacancy were eradicated largely. Rents started to go up. Turnovers went up dramatically. Like, I have one example. I was looking back over the weekend at some of the numbers. We had one retailer in a non-Dublin fashion-based scheme whose turnover has gone up by 3.5 times since late 2007 to late 2022. So that's an amazing turnaround in terms of turnover, and yet I can't remember any commentary covering that. So we've emerged as being a high level of rent sustainability, and that the basis which supports the rent, the ability of the retailers to pay it, is ultimately the sales going through the tills, and we've seen a very strong improvement in terms of that sustainability overall.
I can tell you, being immersed in this industry, I've never heard of a 7-year retail boom during that period. So you're absolutely right. Probably there wasn't reporting based on the data. But look, that's something that we know is changing now. Obviously week after week here, I'm kind of banging the drum about PropTech and construction technology, and so much of it comes back to data, that we just previously didn't have the data, now we do. I've introduced you as the executive chairman of Bannon, but you wear a number of different hats. So you might just talk to us how you in your professional life are transitioning towards this technology driven side.
As you talk about technology and data, I think ultimately the two are welded together from a prop tech perspective. I think what we saw back in 2013, when I mentioned at the start of what we described as a retail boom, with a lot of investors looking to come into the market, American investors, private equity and hedge funds, who saw a recovery opportunity in Ireland, and they wanted data, and they wanted. So we had, I remember one American investor coming over and asking me for a 5-year cash flow on a unit by unit basis across portfolios to shopping centres. And I sort of naively told him, well, we don't do that. We just tell you what they're worth today in terms of look backwards. And he very succinctly told me that unless I was willing to do this, I wasn't going to be working for him. So I quickly learned that I needed to gather the data and try and work out, how to answer a question like that. How do I tell him what the butcher will pay for the next 5 years, what the newsagents pay, what the jewelers will pay. And that caused us to go off and collect the data on their performance. So we really started to get into the weeds in terms of how were these businesses functioning? What was their dynamic for being able to pay their rent or more rent or less rent? And we started hoovering up this data, partly because people gave it to us, because during the recession, during 08 to 13, retailers were coming in and offering us the data in terms of their position, because they wanted to discount their rent because they were paying those 7 levels and they needed to rebase their costs. And then we developed an internal software system to gather that data, report that data, because all of a sudden our clients weren't around the corner, they were in New York or they were in London, so they needed a basis of being able to get a very succinct dashboard-based reporting system that we could communicate to them in a very numeric way the performance of their assets. Because that was then leading into a massive spreadsheet of assets across the globe. These guys didn't care whether it was a canning factory in Sweden or a shopping centre in Dublin. It was all about performance of the assets. We used that, I'll call it a PropTech solution in terms of our bespoke sort of property reporting platform to sell our services to more investors. And we found it regularly met with comments. I remember going to the UK to meet investors, and the guys who I thought would have access to this type of data themselves, and they were dumbfounded by the ability to get so much data so quickly on the performance of their assets. And it's been a very strong component of our growth of our business, to get such large market share in the sector, because we've been this unhoovering up the data. But the data in itself has no benefit unless you can present it in a legible format and analyze it to come to some recommendations and conclusions. And that's why we have been so vociferous in terms of calling out the inaccuracies we sometimes see in terms of the narrative around the sector. Like even last week, there was a comment upon retail sales falling for 6 months in a row. Get behind that data. Retail sales in October in Ireland were 6% higher than they were in October last year. The volumes are down, but the values are up. The inflationary compact, you're spending more money for your money years when volumes were up and values were lower. It was the values that were being reported on the volumes. So the media will pick the story that suits the narrative, and people are drawn towards that. I'm not suggesting that isn't an impact negatively on the retail sector in terms of what's going on. I'll give you a good example. We a number of years ago, back in 2014-15, when we had a number of private equity investors in the US coming to invest in the Irish retail market. I remember meeting one particular investor, and they asked me for a 5-year projection of income on a tenant-by-tenant basis across a portfolio of 6 shopping centres. I said, we don't do that. We tell you what they're worth today. We do valuations. We look backwards. And he basically told me that if I wasn't willing to do it, I wouldn't be working for him. So that caused a sort of a trigger moment. It was a key moment. I remember that meeting because it really drilled home to me the whole importance of data and the fact that we had this data at our fingertips and we weren't using it effectively. So we looked at the data we've been given by retailers over the previous 5 years when they were distressed post the crash, and pieced together a view as to the true sustainability of rent flow from retail going forward. And that's probably sort of highlighted the position that we've been pushing over the last number of years, that stop looking at the sort of headline narrative and start focusing on the true sustainability. That if I've got a butcher who's paying 60 grand a year and he's turning $1 million a year, and the population is going up in the area, unless I see more competition coming into his fields, then that's going to be a very sustainable picture going forward, and I can track that income going forward. If by contrast I've got someone in a fashion business which is suffering a lot of competition, or the demographics don't suit them going forward, then I've got to look more questioning at that income going forward. And it's getting into the weeds on that that's really been beneficial for us. So what we had to do was create then a PropTech solution, a form of software that would allow us to gather that data efficiently, because it's quite costly to spend time doing it, and then present it to the client in a way that was assimilable to them. And they wanted sort of the 30-second take. Show me the dashboard, explain to me. I'm going into a meeting to meet my colleagues. Show me the 6 pieces of key data to tell me how well my asset is performing and my portfolio is performing, and then allow me to drill into the weeds in that if need be. we produced that, and that's been something that's been highly successful for us in terms of growing the business over the last number of years. That the ability to tell people the data about their assets. That also provides us with an opportunity to analyze that data. So if we know from our existing portfolio of a couple of thousand tenants what's working and what's not working, then if we're looking at buying a new shopping centre for a client, we can analyze using that data. Okay, what is the prospect of this income flow enhancing, reducing, sustaining over a period of time, which allows them to make a decision about what represents value.
Neil, you talked about the narrative that was prevailing. Then you got the data that actually showed the reality. But actually, the negative retail narrative that continues, and in fact, only in recent days I heard you kind of challenged on your positivity around the sector, and I thought that you dealt with it in a very, what I would say, data-driven way, and that was to say, the claim was put to you that retail is failing, and you were adamant, no, retail is not failing, retailers are failing. And that's a very important distinction that maybe is being missed at the moment. Can you explain a little bit, just because this is something that's topical right now across, certainly across Dublin and Cork city centres?
The big example for that is the impact of Brexit in terms of what we've seen since Brexit 2016 in the UK is a widespread failure of a lot of UK retailers, high street retailers as they'll be called. And if you call it out, Debenhams on its own, plus House of Fraser, left 1 million square feet vacant in the Irish market. That one failure. Imagine what it did in the UK market, where there was a Debenhams House of Fraser in every town across the UK. We also lost Topshop, Topman, Coast, Oasis, Burton's, Evans, Debenhams, Monsoon. The list goes on. And so we've seen vacancy in the market, and those are headline grabbing names. So the narrative persists in terms of those failures, but they're not failing because of Ireland. They're failing because they're failing retailers, because they went bust in the UK because of the problems they have over there, or because they were heavily leveraged through to historic buyouts. So we have people will grab those headlines and pay a lot of attention to them. And if you look at what's happened on Grafton Street, we've lost a lot of those key retailers over the last year, but we've done deals with Lululemon, Lego, Canada Goose, Russell Bomley, Penhaligon's, Montblanc. These are very nice names, brands coming into the Irish market. We don't get much collective discussion about that. We get a lot of discussion about the failure. So I think if you stand back and look at the Irish market versus the UK market, we're very different in terms of our makeup. The vast majority, I think there's only 7 or 8 shopping centres in Ireland, significant, that don't have a supermarket in them. We're very convenience, grocery based, necessity based shopping, as we call it. We have very few traditional fashion-based high streets, which you would have an awful lot in the UK. We have 4 or 5 in Ireland in reality. So they're reported in the same manner, because there's a sort of drag across from the negative commentary in terms of the UK. Vacancy in the Irish market is very, very low, and that's something that I'm very heavily commentary on. But I say we manage a quarter of Ireland's stock, and our occupancy rates are in the high to mid-90s across the entire stock.
Neil, look, there's no getting away from the fact that e-commerce has changed retail. But from what you're telling me, there's a real trend in what's closing and what's exiting, maybe high street retail, and they're being replaced by very premium, high-end brands. Is this a trend? Like, what do you see when you're looking at forecasting? And we've just talked about the importance of forecasting. What are you seeing for the next 5 years of retail?
I think the brand is the most important word there, Carol. Brand is everything in terms of retail, and what you're seeing, if you look at the likes of Debenhams by comparison to Brown Thomas, so 2 department stores, the Debenhams existence didn't add to the purchase. You went to the Debenhams, you bought an item, you might have bought a Topshop item, or you might have bought a Coast or Oasis item, but the Debenhams bag itself did not. The brand didn't add to the experience. The Brown Thomas bag adds to the experience. So you see what Brown Thomas did when they took over Arnott's. They immediately positioned the Arnott's bag as something of the bright blue bag. It's very noticeable. Everything else, the brand of the department store is adding to the overall experience, and Selfridge is very successful over the years. So brand is made for an omni-channel retailing world, where you're you're in store, you're online, you're buying, you click and collect, you're returning, you buy something, you deliver it home, you return it in store. So brand works very well in an online world because you know what you're getting, and if you, by contrast to that, if you don't have a strong brand, then you're trying to compete online, you're nowhere. But if you look at the online narrative is interesting as well because it's overdone. Like the reality is, according to the CSO, 95% of all retail sales in Ireland still take place in store. Even in the UK, which is the absolute market leader in terms of online retailing, they still know 82% of retail sales still take place in store. So the growth of it has sort of obsessed people in terms of its impact on the marketplace. But all that really is an impact to supply demand dynamic. Okay. So in Irish context, sorry, Carol.
No, continue.
In Irish context, we have very solid data from a long period of time over the impact of online sales. And if you ever want proof of this, go back to the pandemic. Shops closed, everyone bought online, shops opened, who went back in store.
Yeah. Look, I think the last 3 years have been particularly, or 2.5 years, have been a particularly strange time that's left us really not just questioning retail or the future of the office or the future of the workplace, but even the future of how we design our homes, and what they will look like, and how we use real estate, because a lot of our perspectives are shifted and we just don't know yet. It's too early to call how many of those changes are going to be permanent. So Neil, thank you so much for being so generous with your time. I suppose one final thing that I'm curious about before we finish up today, you mentioned there that in terms of, I thought that was a really really interesting stat that you opened with today, that of the 460 buildings on your database, 400 were built in the last century, and the remaining 60, most of those, are coming up to 2 decades. You also mentioned that office is leading the charge in terms of the sustainability push. Where does this leave retail and the physical buildings that retail occupy in terms of sustainability? Are you just seeing a massive retrofit, or do you think that this is just going to fall off the radar in some way, that it's going to be a case of barely compliance?
I think retail's environmental performance is driven largely by what happens within the retailer's box themselves. So the shopping center or the retail park doesn't use an awful lot of energy by comparison to what happens inside the store, and how they source their products, how they dispose their products, how they deliver them, how they light their stores. These are massive impacts in terms of environmental performance. At the moment, we're not seeing the consumer drive change there. So the consumer is faced with 2 stores, and one is brightly lit by non-LED lighting and is almost warm to the touch. They'll go in there as happily as they'll go into the one next door that is environmentally fitted out, because they're driven by the product. We've seen a lot of talk about the impact on fast fashion with environmental concerns. Again, the consumer's not following that up. If we saw the queues of people down the street to Pennies when they reopened, we're not seeing an awful lot of consumer behaviour that would indicate a green drive, despite this. So the corporates are doing it on the office side. The retailers will do it when the customers tell them to do it. And at the moment, customers aren't doing too much of that.
Yeah, okay. So that's really going against a lot of the woke narrative that's out there at the moment. So it is a case of a make me pure, but not just yet. Okay.
Yeah.
Neil, thank you so much for being so generous with your time. Lots to take in there, and it's definitely something I'd love to pick up with you again in a few months' time, particularly kind of on the PropTech side and the PropTech solution. But for now, thank you so much. That was Neil Bannon, Executive Chairperson of Bannon, and we need to take a quick break now. Stay tuned.